Are the two oldest weekly paying dividend ETFs still worth holding today? In this video, we are going to cover ticker QDTE and XDTE, two weekly paying ETFs by RoundHill that really changed how we invest for passive income. If you don't know who I am, my name is Spencer, and I talk all about ETF investing with the primary focus on income. And I've been tracking these weekly payers since their inception over a year ago. I'm really excited to get into this video, but first, if you're interested in weekly dividends, in monthly dividends, don't forget to like and subscribe. Let's roll that intro. Before we look at these ETFs, I want to showcase the power of the 0DTE options. And what's interesting is this is a Income Shares website. It's showcasing how these 0DTEs work, which stands for 0 days till expiration, meaning you write the call or you buy, purchase, sell, whatever you want to say, the option in the morning, and it's going to expire by the end of the day. That theta decay is high because you have a very limited amount of time to exercise the option. Now, I don't like doing these because there's a lot of work. You have to be very actively trading. So I don't do these with my option strategy. I run the wheel primarily, but they're really cool. And when you have a fun doing it, that's an expert in, how these work and making sure you get the most out of your money with them, it can be great. Two examples, TDAC and TSPY. TSPY has been out for over a year. TDAC just launched. They both utilize 0DTE call options, and it's phenomenal. I like both of those funds. They yield very high and they've been very consistent, and you get some price appreciation. But I'm not going to dive into exactly how the options work, but just know that's what it stands for, the 0DTE. And what you have with that is you have a lot more freedom because you're able to write options each day. So let's say over the span of a month with a normal options contract, you buy a month out. So many things can happen during that time period. We can see a week where there's a lot of earnings, people are anxious, the market's been going down, it's looking, pessimistic. And you say, well, you know what? I don't think the market's going to go up this week. I'm going to do puts instead of calls because I think we're going to be in a little bit of a downtrend. And then the next week it rebounds. So you have to have, of course, a really good strategist that can try and predict what the market's going to do based off events. But 0DTE gives you the ability to change week to week or even day to day, which is amazing. Those long months out, you are at the mercy of the market. And so that's why these are very, very powerful. Another reason is the stock market closes. It's not like the crypto market that's always trading. The stock market it has certain times depending on where you are. But it's important to know that there are also pre-market and aftermarket hours. And what's happening is because these are covered call strategies, you are able to, they already hold the S&P 500 or the NASDAQ. So they hold them. And what that does is if they do really well in the pre-market or in the post-market or aftermarket, you still gain or lose those returns. And since I'm long on the S&P 500, I'm long on the NASDAQ, I think they will do primarily better in both pre and aftermarket trading. That wasn't the best example, but I hope it does make sense. It basically gives you have all the exposure to the underlying assets. And since you can only write options when the market is open, once they sell out, let's say, we get great news in the aftermarket and boom, the S&P goes up 1%, you're still getting that increase in value because they hold it or you hold it through the ETF. So I hope that makes sense. 0DTEs, they're a little more complicated. They're not really a beginner strategy, but they aren't awful to learn. I'm definitely not an expert. I'm still learning these, but it is really cool. So now let's jump into our two options for XDTE and QDTE. One thing I do need to mention that I forgot to mention in the prior clip is that these utilize a synthetic covered call strategy. So you don't actually own the underlying, they don't hold it, but they do get that pre-market and aftermarket appreciation or depreciation because this synthetic long call strategy is what they're using. So they still get a bonus to it, but it's not the same as a one-for-one with holding the underlyings. QDTE is a very interesting one though, because I believe that QQQ and QQQM, I believe the NASDAQ will outperform the S&P 500 simply because that's what we've seen. I love both. I have both. I diversify with both, but we've seen QQQ do really well. And most of the QQQ funds outperform their S&P funds, I will say, which is the same case with these two. But we'll get into that. Now we can see weekly distributions, which is amazing. These things were so wildly popular. I remember one of the first videos that I had that really took off, got 15,000 views. It was on QDTE when people were looking it up and trying to figure out, is it worth it? How do we use these? And so I do owe QDTE a little bit of the success for the channel. But they're going to generate income through those covered call strategies on the Innovation 100 Index, or QQQ, and it sells the 0 DTE options on that index and seeks to exploit structural market mispricings as a little bonus. They have a distribution rate of 43%. These are priced in as they take the last distribution and they take the current price at the time of that distribution and they calculate a yield. It's not trailing 12 months. It doesn't really showcase the actual yield. It's a little bit lower than this, I believe, but we'll check it out. And you can go down and see these things do have a really big expense ratio, 0.97%. Not as bad as some of the other weekly payers, I will say. And we have an AUM of 910 million, which is phenomenal. And it's an active management style. One thing with the 0 DTE options, they are doing a lot more work than you would with a normal 30-day option. Yeah, of course, there's the same. You have to research, you have to understand or try and predict what's happening in the market. But I mean, I understand a high expense ratio for these. We can also go through and check. It's just the NDX index, their calls. You can see all their pricing, yada, 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 the distributions as well. So QDTE and XDTE are the same in every way except for the underlying. So we're not going to do this for XDTE as well. What I do want to showcase is the dividend reinvestment calculator, or DRIP calculator, and let's see how these have performed. Since inception, we can see that QDTE has outperformed XDTE. And one thing that I think is really cool with these is they did not do well during the crazy price drop that we saw in March, April of this year, but they rebounded very nicely, which is hard to say. I'm not trying to throw YieldMax under the bus, but if you look at YMAG and YMAX, they did not bounce back like this at all. Maybe they did more with dividends reinvested, but it's just a slower climb for them. But I'm happy with these. I mean, we can see total return 26.23% with QDTE, XDTE 22.03%. Now, I want to say this again. These are income-focused ETFs. They're not made to outperform the underlying. They're made to perform similarly, a little bit worse, I would say, but also provide income. That's the cost that you get with income versus growth. But I don't want comments saying they underperformed the indices. Yes, they're not made to outperform it. And that's the way that it works with options, especially in the market that we've seen. They're not going to outperform it. Because if you don't know, really green market growth is going to do way better. In a kind of green market, slow growth, the income funds will do well, probably not as well. In just a sideways market where you have years of not a lot of price movement, but you have up and down over time, but not steady growth, these will outperform because you're getting more. You don't have the growth aspect for growth stocks, but you are getting the premiums from the options. So there are instances where they work, but all in all, the income versus growth argument, income is not going to outperform most of the time. But we can see 10K invested into QDTE gets you $12,600, XDTE $12,200. Your average annual total return, because they've been out for about a year and a half now, is 16.85% for QDTE, and for XDTE 14.24% with dividends reinvested. It's significantly worse with dividends not reinvested, which definitely is a caveat, because people are investing in these in order to get the current income. So your change goes from what you had 26% total return to 19.5% for QDTE. And for XDTE, you had 22% to 12%. A big drop there. For me, I'm reinvesting my dividends to grow the positions and get that compounding effect as well. All in all, I am impressed with these. We are going to look at one more calculator using Seeking Alpha's comparison tool, which is going to be very, very important. And I'm really curious what it pulls up. I have pulled up the 3-year history for both QDTE and XDTE, and we can see, similarly to the YieldMax funds, they did drop. They haven't rebounded quite nicely, and QDTE has performed worse. But this is not including the dividends. So with dividends reinvested, we see a completely different picture. We have QDTE up 27.28% and XDTE up 23.09%. They do go pretty hand in hand, actually. There's not much disparity, although QDTE has been outclimbing XDTE. And I am impressed with these. The dividends have been consistent. They've been solid. I did own them for a little bit. I did end up selling them because they weren't doing as well as I thought, but that's just the way that it goes. We had others that were performing better, and it was just what was going on in the market. Since I sold them, they have done really, really well, unfortunately, but that's just how it goes for me. If I sell something, it absolutely rockets to all-time highs. If I buy something, it has the worst quarter performance in its lifetime, and I'm out a lot of money, but it's just a gift that I have. Both of these do have the same expense ratio. XDTE is a bit cheaper at $420 million. But there's tons of good stuff that you can find with their dividends. So even if the dividend yield is higher trailing 12 months, we have to factor in that NAV decay or price depreciation over time. I do love, of course, high yields, but total return is most important to me. It just is, and that is because I'm not planning on retiring and living off this income, so I just want it to be solid. I don't want my initial investment to decay, which is hard to do. But I do want to give props to QDTE and XDTE for kind of paving the way for all these new weekly dividend ETFs that we have. They also have RDTE, which has paid out more in dividends, but less overall return in comparison to these two because it is a little bit of a higher risk asset on the Russell 2000. We see that with all the Russell ETFs, they perform worse, and the Russell has just not been doing nearly as well as we had all hoped. But if you want more content on the weekly dividends, on monthly dividends, don't forget to like and subscribe. And if you enjoyed this video, check out these popping up on your screen right now, including 9 ETFs with zero NAV erosion that I know you guys are going to love. Thank you so much for all the support. 30,000 subscribers is amazing, and I hope to see you in the next video.